But you need something that's going to encourage you in the beginning. And by having something that has a 70% likelihood of panning out, why do you think I want a 75 handle or more opening range gap? What is half a 75? It's an easy 25 to 30 handle run. And that's all you need. Once you get that, you can turn your charts off and go fishing, go to the movies, take your significant other out for a date, go have lunch, go back to bed, play some Xbox and PlayStation, whatever you want to do. Go to the gym because your day's done. Think about how fast the 70% repricing to mid gap went into large range gap. How many times have you seen that happen? How many times have you seen it physically happen? Just like that. And how many of you thought to yourself, if push comes to shove, if this is all I get good at doing, how's that a failure? How is that not a clear model that could take your fucking ass right out of that job that you're worrying about every day losing, and why you're not getting the raise, and how much more time you got to put up with fucking Carl? This fucking guy is constantly looking over your shoulder asking, so how's that trading going? How's that Forex trading going? You ready to quit your job yet? You're going to be a lifer like me. You know you are. Yeah, your corporate team, baby. You are never getting out of here. I told you when you first told me this stuff, it's never going to work for you. Looking at that opening range gap, understanding how it behaves, what you can do with it, will separate you from putting up with Carl's bullshit. You won't have to go and work with that asshole anymore. But you have to submit to the time to getting good at reading it, not over leveraging, but one contract, one of them traded 3 instances over a week. You get two trades, one trade. See what I did there? I brought you back to just one trade, one good trade a week. And it could be just inside that opening range gap. And you don't need to know where the draw on liquidity is right now. You have something that can feed you, put some grocery money in your pocket, pay your mortgage note, or half of it, or a portion of it. And that little tiny victory, that little tiny footing, that sure footing underneath your feet, will give you the confidence and to remind you, you know what? I made the right decision doing this. Something pushed me into this pathway. It didn't happen by circumstance. It didn't happen because of, luck. You were placed in my path for a reason. We came together for some cosmic reason, okay? And all you need to do is give yourself the opportunity to taste it one time, following the rules. And when you do that, you'll have every bit of the confidence to lean back on that one moment, that one instance where it happened in your hands. The bug will have bitten you. You will have been infected with it. You're ICT positive now. You're infected. And you'll go in looking for these types of things, these smart money signatures, and it'll encourage you because you've tasted it. You've seen it happen in your own hands. And it'll give you confidence to go in and keep doing more and more and more. And as you find more opportunities where you follow the rules and it pans out in your favor, it rewards you for following the rules. It does not punish you for being patient. It rewards you for being patient. It rewards you for being diligent and selective and in looking for this weak-handed arm wrestling match against ill-informed people that pretend that level 2 data gives them some kind of advantage, that pretends that volume profile has some measure of importance over price. It has no importance over price. It's only showing you what's already happened. It's not telling you where it's going to go. But understanding how looking at less informed traders and how they think about the market, how they internalize what price is likely to do. And when they get sentiment driven, a gap opening higher, the public's going to eat that up and think it's bullish. And when they start to run it up a little bit higher, you're going to smile and you're going to say, I'm not buying that. That's the Judas swing. Because inside that opening range, that first 30 minutes, a Judas swing is going to form. And the gap is telling you right away where the initial draw is going to be. A gap higher, okay, you're looking for mid gap. Is there a range in there for 25 to 30 handles? You have a shoe in easy lead pipe cinch trade. All you got to do is wait for it to come down below a buy sign, balance, sell sign efficiency if it's gap up higher. Once it breaks below that, look for that gap to act as an inversion fair value gap. That's all I did Friday. That's all that was. That was not me painting a fair value gap to go long in. When the whole time of that morning I was saying I would not be buying this. I would not be buying this. I would not be buying. I told you, even if it ran up to primary buy side, I would not be in that long. Why? Because I taught you the opening range is going to be like a black hole, a vacuum that's going to pull price down into its midpoint. And how it trades to that midpoint in terms of the speed, how fast it gets there, and what does it do as soon as it hits it? Does it pierce right through it? Or does it repel back up? Or does it trade down through it and come back up and treat it as resistance, as a premium array, and then sell off even more and go for 3/4 gap closure? So we're not fooled by these assholes on social media anymore. They want to take things out of context because you have documented facts being shown to you in live stream. I'm not ambiguous. I'm telling you what I want to see, what I'd prefer to see, and where the actual PD rates are talking, where they're saying this is what's likely to do. And if you can't see that, you're lost. You're lost and you're untrainable. You're unteachable. I can't do anything for you. But nobody should be able to listen to someone's opinion and not at least watch the live streams, because that's undeniable factual proof that this is something that you can do. The concepts work. I can see it doing it. I can outline it. And you watched me push the buttons this week, buying and selling with the one contract would be, let's say it's hypothetical $10,000 account, over $3,800. That's 38% in one day, in one session, in 1 hour. 38%. And some of you people come up to me, I made 4%. I made 2.5%. I'm out trading you. You have no idea what you're talking about. Like, that's silly. That's fucking silly. I have students that could literally whip the shit off of anybody out there that talks the loudest that is opposing to my content. I got students. I don't even need to do anything. I say, okay, just try to do better than her right now. Try to do better than him right now. Can you do what they're doing? Because they're doing it right now and they're running circles around you. Again, they're romancing the uncertainty. They need people to support them. They need people to look up to them because they don't have any confidence in what they're doing. They have to have it externally. And I was like that when I was 20. I was absolutely like that. And I'm trying to remind you all, especially young men, don't do that. You don't need that. You're going to learn how to do this so well that it's fun when you're walking around in the grocery aisles, you're walking through the stores, and these people are looking at you, and you're looking at them, you're thinking, they got to go to work tomorrow. They're probably struggling and worrying about how they're going to get their mortgage paid. They're probably worrying about how they're going to get that child, the 2 babies they're pushing around their stroller. They're probably wondering how they're going to get a college fund put together to pay for them to go through college. They're worrying about things that you're not going to be worrying about. That's a blessing. That's an enriched life. That's a blessed life. You don't need somebody. If you're living like that, you don't need anybody else to pat you on the back so you're doing well. You already know you're doing well. Your life is a testimony to that. And how you think. New money needs assurance and assurity given to them from external sources. New money always does that. New money always looks for instant gratification and the acceptance of other people. Anybody that makes money for the first time, whether trading, win the lottery, they get a good paying job or whatnot, they immediately want to expose themselves to stimuli outside themselves because they want a third party validation. because they can't even believe where they're at either. Like, they can't believe it. It happened so unexpected. They think that it's going to be stripped from them any moment. So they have to live in the moment right now. And that's why you see social media cultivate that mindset. In trading, it's the most toxic thing you can do. Because what you're doing is you're teaching yourself to believe that that's what matters most. Other people's perspective and opinions about you and what you think you can do is the only thing that really matters. What other people think that you're worth or what you're able to do is useless. It's useless information. It's wasteful energy. But unfortunately, young men will take that as yeah, I'm a goat. I'm the greatest to ever do it. I'm a king. Come on now, stop. Anybody's opinion of you, whether it be high or low, has no direct bearing on your performance as a trader unless you allow it. Don't romance these little relationships that are laid in front of you where people can worship you or troll you. Don't even give it any energy. Don't give it any energy, because if you spend time in the market and you're looking for your setups, are you thinking about Carl before you put your trade on? Are you thinking about that person that you just can't wait to rub their fucking nose in it? You can't wait till this ends so that way you can say, hey, remember when you told me this, and this? Chances are, if you're taking that trade and you're thinking like that, you're not following your model. You're trading impulsively, like a retail trader would. You're doing something external to the model. You're looking for a reward, an emotional or psychological reward on the other side of that trade, which means that you're most likely not going to see what? When the market stops telling you it's going to continue what you're hoping it's going to deliver to. You won't recognize when you're finally offside because you're holding on to some kind of external proof that you want to give to somebody else. Instead of saying, this is my model. I'm waiting for it to be in low resistance liquidity run conditions. It's the right time of day. There's manipulation. I'm trading against that manipulation. I'm now trading against what retail would see, and it's the right time to do it. So everything's obvious. It's going to draw to this liquidity. I'm on side. And then when you get the trade on, you're just constantly monitoring everything being equal. You're not looking for some external thing to pony and showcase to somebody. You're following your model because you know following your model is going to yield you positive results. And you're not counting your money before you get it. You're not looking for any reason to run away from your trade because you're uncomfortable. You're submitting to it. Retail romances the uncertainty. They trade this larger position that they really can't afford to take as a losing trade if it's wrong. But they believe, what happens if I'm right? It's like winning the lottery. You are trained to not think that way. You're thinking, how can I manage the risk to such a degree that it's the smallest and I can hold on to the maximum terminus target and then let the compounding effect of pyramiding new positions while never really increasing the underlying risk. That is a professional mindset. We don't romance the uncertainty. We embrace the uncertainty. We don't have any control over the market once we enter our trades. But retail is going to hope and pray. They have hope and pray model. Hope and pray model is not a model that is consistent. Not in terms of profitability, but it is a model that's it's consistently delivering losing traders. Blown out, blown accounts, lost funded accounts, failed combines. Hope and pray model is not something you want to be doing. So we look at things from a time and price aspect where we can say, okay, this is what is reasonable. And we have tools in our repertoire that help us determine whether there's an edge, whether there is a bias, where the market should draw. When the market has created a jaggedness to it. On the downside, sell side's been delivered, and it's been done with multiple passes lower, and they have smooth relative equal highs just above us. That's not complicated. We're not looking for harmonic patterns. We're not looking for continuation patterns. We're not following the trend is your friend horseshit. We're looking for where are the orders that's going to be consumed next. We've already disrupted the market to the downside. We've done that with a lower gap opening. So we have a discount opening gap. we're still inside the first 30 minutes. And there's relative equal highs that are still above half of the opening range gap. So that means we have something we can trade long, because the gap is indicating that first 30 minutes bias is bullish. And when it trades the half the gap, then we have to see, does it want to go higher? If it wants to go higher, then we can trust it's going to go where? To the relative equal highs, because it's already done the damage by making things jagged to the downside, and it's going to want to reach for opposing liquidity. That's not a complicated thing. That's not religion. That's simply looking at, okay, yeah, the market's done enough to try to entice people going lower. Every little short-term low has been taken, and that means that they have engineered sell-side liquidity so that way they can buy it at a cheap price. They're not going to buy it at a cheap price and not wait till it goes higher to sell it at a high price. And that's what smart money does. It engineers liquidity. They buy that liquidity if it's below old lows, and they hold it until it goes above old highs. That's it, folks. That's all it is. That's all this is. It's the game of hot potato. Remember, as a kid, is these little games you used to play, red light, green light, mother may I, all those types of things. Well, it's like, here's the hot potato. You hold it, and then you got to pass it to somebody else. That's what's going on all day long. And that's why I called that little drill, that exercise, volatility pinball, because you're constantly banging around, taking the buy stops, taking the sell stops, buying here, buying there, selling here, selling there, looking for inefficiencies, the fair value gap, use as your entry mechanism, find a reasonable stop loss, and where's the next draw to go to. And it trains your eye to see it that way. And then when you start trading with a 5-minute chart like that, and then you start trading a 15-minute chart like that, then you start trading a 1-hour chart like that, then a daily chart, and then you look at the market like that through the lens of a weekly and monthly chart, you have an ability to look at time over any given time frame and use the same logic. And then if you can start doing that with a weekly chart, you can see where the market's likely to go to for weeks, not just right now, present week, or the week that you're trading in, or the week to come. Like right now, we don't have the market open. It's Saturday. So applying what you're doing and practicing with that volatility pinball drill, desensitizing yourself to entries, if you start looking for that same idea on a weekly chart, you can see, oh, the market's most likely going to draw down to this old low here. Does that mean it's going to happen in 1 week? No. It just gives you a long-term or intermediate-term draw on liquidity. So that way, you might be a buyer or seller throughout the week, but you can anticipate that your larger short positions with the most leverage will be placed on shorts, aiming for that weekly draw on liquidity that may be beyond the scope of this present week's delivery. It might only go down a couple hundred handles this week, but you're looking for it to trade down 1,200 handles. So it keeps you in check and telling you, don't try to look for the long that it calls the bottom. Focus primarily on looking for environments where the 15-minute to hourly chart runs above relative equal highs or an old high, and you're going to anticipate that, setting the next leg for a price low or delivering to that weekly draw that is going to be way beyond what you think is going to happen just in 1 week.